the dollar price of gold at $3,000 and silver at $50 looks far too cheap during Trump's second term.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault. And the first thing is Happy New Year. I know 2025 is going to be such an amazing year for all of our community and our growing community. For the people that are here brand new, Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times that we're all living through right here and now. And, we bring you exclusive access to experts and insiders, and we reveal information and insights that you simply won't find anywhere else. Hi there, my name is Shane Moran, and I'll be your host for this week's episode. And we'll be joined shortly by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of the gold and silver markets, and we expose what's really going on in the precious metals industry. So get ready for another packed episode of Live from the Vault, and we'll bring you the knowledge and we'll bring you the understanding that the mainstream media just will not provide. So just before we head over to the UK, please help keep spreading the word in this new year about this channel by hitting that like button. You can do that right now. Share this information so more people can find out about the precious metals industry and the insider information here. And if you haven't already subscribed, just go ahead and click that subscribe button. And if you want to be notified in real time as each episode goes live, just hit that black bell right there and we'll notify you again as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, first of all, Happy New Year. I guess the first thing that I want to do is really ask you, as all of our community is asking, can we pick up on the thread from where we ended up last year? It seems like a long time ago, but last year at the end of 2024, and have a look at what we can expect to start this new year, 2025, trading here in the precious metals industry.
Yeah, Happy New Year, Shane. Happy New Year to all our valued subscribers. So we've got lots to get through. It's been a few weeks. Let's get through as many questions as possible in the time we've got. So perhaps let's start with the short-term New Year action that followed the December end-of-year casino-driven selling. We'll get into this, don't worry. Then, based on extremely reliable first-tier liquidity feedback, I'm going to expand on why the dollar price of gold at $3,000 and silver at $50 looks far too cheap during Trump's second term. Now, more immediately, Asian buyers have notably stepped up their bargain hunting in both gold and silver, which has been forcing the commercials to begin to ring the register. And remember, we were tracking these automated momentum sellers who control basically 75% of everything that the casino churns out. So basically, they were beginning to ring the register on these guys. But what's happened is following each Asian unleveraged physical buying session, and you can just look at any chart and you see in the morning that Asia buys, then what's happened is then the momentums are happy to take this 96% leveraged synthetic gold, and then they automate selling gold into what has been really a dollar rally, which during the first two sessions of 2025 tagged its highest level since November 2022. So that beggars the fact is, then why is gold not dropping? Well, it's because we're going to go through why. And there's some massive changes going on here. And just as we reported during our end of year market update episode, with no single point have house insiders, had they or are they adding any shorts or making any bearish bets against gold and silver. That's something that they couldn't hide in the COT reports. that spanned the period since our last episode, COT reports simply being what little information the House has to publish to the CFTC. And this is because the House insiders are exposed to physical delivery obligations from outside the cash-settled COMEX exchange, and because Basel III regulations ultimately force physical delivery, so the House is unable to halt the outflows of synthetically discounted underpriced bullion exiting the COMEX to fulfill global central bank demand.
All right. Now, Andrew, I can remember our very first episode back in 2023, 2 years ago, just as the Basel III regulations took effect. There was a lot of questions, and you were the first, to come out and start talking Basel III when no one could even spell it. And just as you predicted, though, with gold trading, and it was back then in the low 1800s, you projected that gold would close well above 2000 before the end of 2023. In fact, spot gold closed at the end of 2023 at 2062.40. Now, during our first episode a year later, or a year ago now, episode of 2024, you assessed that the Basel III, again, we started off with Basel III, and the physical gold effect alongside with the physical markets being settled outside of the COMEX would force a fiat price of gold to rise exponentially. In fact, despite multiple COMEX attempts to cash settle gold, physical gold demand forced gold to rise strongly during 2024. Everyone witnessed that as you projected. In fact, closing the year end at about $600 an ounce higher.
Yes, Shane. As a reminder, and to update new subscribers, of which we have many, following Basel III NSFR conditions being imposed on the 10 times larger foreign exchange market liquidity providers, every single bullion bank has actually been coattailing every global central bank, except the Fed, that is, and all these first-tier market-making bullion banks went long physical gold and silver, coattailing the central banks, and they went long for their own books, naturally, because they got a view into the physical markets. So when we look at the makeup of the what is counterintuitive House insider gold suppression footprints, which we evidenced into the close of the 24-year trade, we're really talking about the three agent bullion banks forced to act on behalf of the Fed, who remain the only global central bank still trying to cap the dollar price of gold. I mean, it's ludicrous, but it's happening under our watch. Now, many of our subscribers' questions during 2024, as you've just elaborated, they sought to understand if the Feds have unlimited fiat pockets, which they do, so they could really continue to fly. Could they not continue to flywheel this 50-year price suppression scheme, which is what the COMEX was specifically formed to do? Namely, that was after Nixon suspended the dollar's convertibility into gold, into synthetic, so that they could synthetically dilute thousands of tons of gold to dissuade foreign central banks from swapping their unbacked dollars for physical gold, because they were trying to keep the price the price volatile and wrongly positioned. Now, while it's true, that the Fed has virtually unlimited printed dollars to keep the siloed COMEX over 50-year price capping scheme rolling, following Basel III, recategorizing physical gold as a first-year asset class on the 1st of January 2 years ago, almost 2 years to the day, it forced the 10 times larger global-facing foreign exchange markets to back the 17 trillion a year foreign exchange gold offerings with bullion, thereby limiting the House's ability to keep fractionalizing what is a rapidly depleting stock of house leverage bullion bars. Now, despite gold rising by over $600 per ounce, despite their best efforts to dilute the gold price against a rising dollar, all that happened was the Fed revealed its weak poker hand. But following this over 50 year legacy gold price suppression, they are so deep in, they had little option but to double down. And the problem is that outside the siloed casino bubble, every other central bank is capitalizing on this bluff, busted hand, which is, in poker terms, what it is. Now, the Fed is rapidly running out of the necessary bullion that they rely on to dilute the paper price of gold. Now, despite the ability to leverage their undeliverable casino chips by a massive 96%, it beggars belief, but that is what you're seeing. Anytime you see a trade on the COMEX, it is only 4% backed by any bullion. So what they're doing is despite this ability to leverage to that degree, which is about hiding the fact that the debt-based dollar is actually losing purchasing power as benchmarked by unleveraged first-tier gold, FX gold, that is. So the rubber actually meets the road at global gold fixes, which actually sets the dollar price of billions of dollars of accrued Fed-held derivative bets. And that's what really this is about. It's not just what's being traded on the COMEX. There are massive derivative bets, which these prices are trying to protect. Now, ultimately, the Fed's agent bank losses are insured by the Fed, but as the rising gold price illustrates, this is a losing battle, which will have to be resolved by paying ever higher prices to balance the paper to physical book.
Hey, Andrew, can you share insights on how the physical gold versus the paper gold casino markets are performing, and where do you see the discrepancies here?
Yes, Shane, good question. Now, the stripped down charts is really the best way to reveal the degree that the Fed is losing the paper to physical battle. This is why we track actually the 96% leveraged COMEX footprints. Obviously we track the spot markets because they are where the physical markets settle. But in order to really see what the game is, we have to actually track that the Fed, these contracts, these COMEX contracts, albeit leveraged. So let's pick up the thread.
Now, we've been tracking these Fed footprints all last year, revealing the massive losses they faced after borrowing physical bullion from the Bank of International Settlements to leverage and sell this bullion at market to try and bolster depleting COMEX reserves. But as we can see, every single effort from March onwards to dilute the gold price during 2024 backfired, forcing them to repeatedly buy back this sold bullion at ever higher prices. Now, I have to go scroll back a little bit to see where this first really notably started. Now, after getting wrong-footed by the PBOC on the 1st of March, which was this blue circled inflection point here, when they opened up, the PBOC opened up the Shanghai Futures Exchange gold trading facility, mistakenly, the Fed began to double down. And here at this point, they had accrued 68 tons of physical gold loans. And what they were trying to do was fractionalize this into around, if you leverage that out, that would have been 2 years. That is 2 years of synthetic global mine supply. And they were doing that at spot $2,000. Now, we're tracking the futures charts here because it's easier to track the Fed footprints because this is where they operate. However, as we drilled down into our last episodes all last year, by the end of August, this was right here, so right at the end of August, we can see that the Bank of International Settlements along the way had actually been increasing their borrowings from the Bank of International Settlements. And by the end of August, they had literally borrowed, they'd added another 89 tons. And that was peaking at 157 tons. But this was $500 higher at around 2,500. Now, given the 96% leverage, they had found themselves on the wrong side of really close to 5 years. If you leverage that out, that is close to 5 years of mine supply. And by the end of September, and that was here, and remember, we tracked all of this last year. By the end of September, they were forced to actually unwind and pay back 64 tons at close to $2,750. Now, these are massive losses. And while the House was able to lay off, and this is where we are currently today, and while the House was able to lay off probably about 50% of these liabilities against the specs inside the cash-settled COMEX, into the process, liquidity providers assessed that around 1 year of mine supply had been removed and alchemized by way of unreported monetary gold outflows. What we're trying to do here is demonstrate the Fed has a weak hand.
Andrew, from what we were discussing ahead of the episode here, you're looking for much higher prices in 2025. Can you step us through this, please?
Yes, Shane. What we're seeking to do here in these educational sessions is to really track where the footprints lead into 2025. And as we've evidenced through the first couple of trading sessions, the wrong at both ends momentums, yes, they're right in the middle, but they're always wrong at both ends. And now we're witnessing them wrong at the bottom end. These guys, as we say, control 75% of all the COMEX chips, the open interest, as they call it, which the Fed relies on to back. They basically rely on creating these unbacked chips, loan them out, wrong foot the specs, and then short cover into them. But this supply is actually dwindling, and this is a problem. Exposed to growing delivery obligations being jumped on into multiple bid pull sessions, and this is, instead of shorting, they're just resorting to bid pulling. And when you have a position concentration, you can do that kind of thing. But again, we're talking about open interest starting to dwindle, and that used to work extremely well. In fact, liquidity providers report commercials buying to hedge strong Asian-driven physical exposure. In fact, really nothing's changed. It actually is far too obvious. Asia buys physical and the West follows by selling paper gold. It does encourage momentums to anticipate this behavior and short sell. And we've seen that on every single pit open session this year so far. But they don't realize they're being set up as patsies. Now, notably, at the New Year Open, gold and silver rose alongside the dollar as it tested its highest level since November 2022, while conversely, liquidity providers report a notable move to exchange strong dollars and US treasuries for physical gold. Now, assisted by this week's obligatory anticipated FOMC now we're recording this on Wednesday, and basically the FOMC is yet to play out this afternoon, this evening at our time. And then, of course, ahead of really the key thing is Friday non-farm payroll uncertainty. These wrong at both ends momentums are still being tricked into capping rises, while liquidity providers with a view into the wholesale markets expect the bullish physically driven change in behavior to continue to actually percolate through into the first quarter of this year. So really, to answer more specifically the question, Shane, let's look at what to expect medium term. So in order to do that, let's look at the real supply demand dynamics that we are evidencing out of China, as it actually provides a really good look under the contaminated smoke and mirrors Western market view.
So, this to explain And really what we're trying to do is explain how this 50-year-old game is starting to expire. So these are facts. As per the PBOC, into November's synthetically gamed Western-driven gold discount, where everyone was wringing their hands saying, oh my goodness, we're going to now drop down to 2,300, 2,200, even 2,000. We had all these calls coming out. And in fact, this was really following the all-time, now we're tracking the futures chart. So this 2801.70 February futures contract high equated to 2,790 spot. So that was the all-time high. And then it was tracked all the way down into the December spot low, and that was at 2602, which included really a round trip $260 paper market flush during this so-called 1 month, and this was all the way to here. And then obviously then we saw this settlement again, the Bank of International Settlements scrambling to cover. But into this so-called market weakness, China's official gold reserves rose, and this is where the report came through, right where the BIS closed. Their official gold reserves rose from 72.96 million ounces to 73.29 million ounces at the end of December. So here, all the way to here. So they were capitalizing on every single possible ounce. So into this 1 month period between the end of November and the end of December, which was right here, what the PBOC did was, in fact, purchase over 11 tons. Now, keep in mind, this was the period the mainstream media was spinning that China was no longer buying gold. And we now have advanced information. They have significantly stepped this up ahead of Trump's inauguration this month.
With that in mind, let's connect the dots. Now, notably, and why the mainstream media were on the bandwagon spinning bearish gold comments, and it was due to it's actually based on the fact that actually the CNY currency was weakening relative to the strong dollar. Now, the dollar value of the PBOC's gold reserves actually fell by 2.10 billion into these official additions that we've just outlined. Strong additions, 11 tons of them. But verifying the footprints our liquidity providers were reporting into the so-called gold price weakness in December, weakness in the paper markets, not in the physical markets, the PBOC was and is actively capitalizing on dollar strength, stealthily selling dollar assets for gold by way of locking in synthetically discounted Western gold at both the AM and the PM fixes for a guaranteed T+1 physical delivery. Remember, we talked about T+1. It simply means that since Basel III, NSFR compliance regulations kicked in, that if you're an FX trader and you're trading gold, you have to have the physical to deliver. So if someone asks for it, you've got to deliver it. It's got to be delivered within 1 day of that transaction. So basically, they're guaranteed this physical delivery. So alongside selling US treasuries to purchase gold, which is the polar inverse of what the Fed is doing, trying to flog their US treasuries. But as we know, these official published 11-odd ton additions do not include unreported large tonnage, LBMA 400-ounce monetary gold purchases flowing out of the West into the East to fulfill a race by global central banks to capitalize on current dollar strength to purchase gold. Now, the officially reported data is just what cannot be hidden, but only partly illustrates the PBOC stepping up to swap dollars for gold ahead of tariffs being imposed. Now, by connecting these three dots, which we're outlining here, trying to bring this all together, it's no coincidence that China's official FX reserves fell in December from 3.26 trillion to 3.202 trillion. That's what it was, into the gold sell-off. So suddenly we see also their reserves dropping. Now, these conversions of dollars for gold are what is officially reported. But what is hidden from view and impossible to track, but empirically evident and hidden in plain sight, is the scale of the 3.4 trillion of shadow banking reserves identified by ex-Treasury Secretary Brad Setzer. These are off the record being alchemized into hundreds of tons of physical gold. They are salted in the state-held banks and Beijing's military complex. A lot of gold and silver ends up moving into the military complex. Now, the mandate to swap dollars for gold does not even account for direct purchases of unrefined global mine supply, all of which is tightening available global supply, raising the cost to buy physical. So this mine supply, if it's coming direct, it's avoiding most of the LBMA, it's avoiding the usual conduits, and it's coming straight in to China, for example. Now, while there are credible reports that back up central bank gold repatriations alongside unreported monetary gold footprints during 2024, they easily aggregate to well over 1,000 tons, or a full 1/3 of global gold production. That's huge. So by looking at the earlier question of where we are right now in the paper to physical battle, the base price for this gold is 2,600, a price which we have evidence being aggressively defended by the bullion banks exposed to global central bank delivery demand. And we're talking about the bullion banks who actually act on behalf of the Fed. There are limitations, and we're trying to demonstrate that this game is changing. Let's look at why. So let's look at why we know this is important. 2,600 and 29 silver was and is the baseline for the Fed and agent banks to short cover into. Now, this is a legacy of how this is evolved, but it's a legacy of how over 50 years of rigged 95% lose, 5% win, house-run COMEX casino position concentration, and it is done by like any casino. You've got a position concentration. You've got the house controlling 95%, and you've got the punters playing around with 5%, just keeping them keen enough to keep winning a little bit. It's enabled this game, because they have position concentration in the COMEX, it's enabled the game to continue, but it's now on its last legs and into this battle, so as to avoid the deer in the headlights syndrome. It's important to understand this stuff, namely where the unleveraged wholesale market inflects against the house's ability to hedge physical exposure. So they cannot keep draining COMEX vaults, and they've been borrowing gold from the BIS to do it. And so we'll look at that too. But as fully expected, the December 31st COT report, and partly captured in the last two COT reports, insiders had already moved to square off large end-of-year mark-to-market settlements, evidencing the agent bank swap dealers, this is the predatory swap dealers, going long against the wrong-footed naked short specs, which is what we said was happening back then. So this was easier to see in the silver report, as you can see, where the predatory swap dealers were short covering into the wrong-footed managed money specs, much more notably. And as we've identified ahead of the holiday, as we had identified just before the holiday break. During the growing wall of NSFR compliant upcoming T+1 FX market delivery exposure, the scope of the end of year officially orchestrated mark-to-market sell-off was limited to the house remaining long against the February 2600 strike. This is the February contract. It has a strike price of 2600. Now, we track the futures markets because this is where the house operates. And as expected, February COMEX futures, which expire in 3 weeks, told us that the 2600 strike was the absolute inflection point where sucked in 96% leveraged naked short momentum supply could be arbitraged against spot indexed 100% deliverable FX spot delivery obligations. Now, note massive COT buying at the futures, the gold futures price of 2600 following the FOMC gaming on December the 18th. We'll look at that in a minute in the chart. But to illustrate how Basel III FX gold compliance is fast eroding the COMEX ability to cash settle this 96% leveraged casino chips before they are EFP'd, meaning the back door of the COMEX that allows it to convert into a physical contract. This bullion is on a one-way journey into physical settled exchanges. So let's track this February contract as it provides a good example of how the 50-year paper-to-physical battle is being lost by the Fed, which is the only central bank still defending the fall in the dollar as benchmarked against gold. It's not even that gold's going up, it's just it's costing more dollars to print to buy the same ounce. And when the House activated the February 2025 contract on the 29th of July, there was a $70.90 premium, contango as it's called, to what was at the time, on the 29th of July, the spot price was $2,390. Meaning if one sold this futures contract, this February futures contract, and then asymmetrically hedged it into this 96% leverage speculators against the Basel III compliant spot gold price, then, and this is the key, as long as the casino could contain the price from rising, this was a guaranteed locked-in $70.90 profit per ounce at the February contract expiry, exactly 6 months later on the 30th of January. Now, I've illustrated that in this slide. So let's illustrate further by looking at a stripped down chart. You know, in other words, not 500 lines here. It's so simple. I've really got rid of a lot of what is really unnecessary. Because what we're trying to do here is look at the bigger picture.
So the link you've just looked at showed a $70.90 potential profit per ounce. In other words, the premium above spot for carrying that February contract to expiry. So now I now fast forward to where we are today, and I'm recording this on Thursday, actually, which is a technical market holiday in the US, so a bit thinner. But basically, we can see now that has dropped to $17, but in fact, it's been as low as 10 into dips. But currently, because of thin liquidity, it's at $17. So I'm just illustrating how that has now contracted to around $15 to $17. Now, so really, what we had seen was this. When it was $70.90, as per the link you've just looked at, the spot was at $23.90. So along the way, this contango had contracted to $50 at spot 25.85 on the 16th of September. And other than a game sub $50 contango on, $50 larger $50 contango on the 11th of December, circled here, this contract continues to shrink to par with foreign exchange spot into its expiry 3 weeks from now at the end of January. Now, as I say, today's at $17, but really it ought to be around about 12 to 13. By the time this is published after non-farm payrolls, it will be back to that level. But this contango is going to fall off a cliff next week. But what we're going to demonstrate is in a minute is that they didn't want it below 2600. And I'm going to sort of follow through exactly how that works. What we're illustrating is while the COT house insiders have successfully arbitraged this contract to zero at 2600, and we saw that this attempt here to arbitrage that, net stable funding ratio compliant spot FX gold support had risen by $210, and talking about physically risen along the way. And this illustrates the 50-year-old Fed-run paper to physical suppression game is being lost. And the BRICS-centric physical exchanges, they know it. Physical settlements of these siloed contracts are being alchemized by real-world physical BRICS-centric physical exchanges. So where fully paid for physical bars have to be lodged at the exchange before they're traded, which is the polar inverse as to what happens at the COMEX. Now, what it's really saying is, if you have a seller who owns a bar, okay, so you're talking about a physical exchange here, and if a seller owns a bar, now at what price is he willing to sell that bar? And this is the point. If it's fractionalized and it's cash settled, then you'll get all sorts of gaming going on. However, there comes a point where, in a tight market, where the actual offer to sell rises, because why would I sell my bar if I think that it's going to go higher, or if the market is tight? It is as simple as that. So you've got this huge divergence between what's going on in the COMEX, in the fractionalized COMEX, and the increasingly liquid physical exchanges in China, Asia, and the South, global South.
At face value, this is how the uninterrupted, over 50-year synthetic COMEX-driven price suppression game worked. In fact, as we evidenced to the CFTC and the Department of Justice in our whistleblower evidence, attested to by Commissioner Bart Chilton in this Russian television clip, which is linked here below. This position concentration allowed these house insiders to mark massive options and derivative positions, billions of them. We're talking hundreds of dollars below fair value, greatly enriching these house insiders while enabling the Fed to manage the dollar price of gold.
So, back to where we are now as this February contract runs into expiry in 3 weeks. With physical support at spot 2600, here, the House was forced to buy the February 2600 strike with a plan to continue to arbitrage the rapidly contracting remaining February spot contango, which will ultimately be at par at the February contract expiry, which is going to be at the end of this month on January the 30th. Meaning that the February 2600 futures level was the deepest available discount the House could possibly lay off on the wrong at both ends momentum-driven sellers. Now, this way, officials have been able to hedge central bank-driven T+1 delivery exposure at the spot 2600 round number, which is deliverable. Now, this is backed up in the House-run February gold option structure, which actually evidences very strong commercial support by these same banks between 2600 and 2680. This means that regardless of the expected short covering gap close rally, which we would expect way above 2750 probably, the minimum of closing this gap here, I'm just talking about the short term here. Commercials have been setting themselves up to be first to ring the register, which they've begun to do, on very large naked short momentum stop layers on the way back up. This process has begun, but it will significantly pick up next week after non-farm payroll volatility settles, which will happen today when this episode is released.
So to sum up, the futures contango premium will now rapidly contract to zero, and given the paper to physical imbalance, likely moved into severe backwardation, forcing insiders to defend this spot-related support as this process picks up into better liquidity after non-farm payrolls on Friday. So in other words, picks up next week after non-farm payrolls. And really, I think we may as well just wait, bide your time until this volatility may offer some great opportunities. Now, bottom line, just as our first-tier liquidity providers had assessed, the scope of these COMEX-centric discounted settlements were constrained to how much asymmetrically imbalanced 96% leveraged COMEX open interest could be covered off against concurrent real market T+1 NSFR compliant physical delivery obligations facing the market making banks. Now, when the February gold to spot spreads fall off a cliff during the last 2 weeks of January, it's going to expose the commercials to upcoming T+1 delivery obligations, and it'll force them to short cover, which is what they will not be able to offset against the momentum-driven 96% leverage short speculators. Now, this is going to bullishly influence deeply oversold silver futures.
All right, Andrew, and for my favorite question, almost every episode I'm asking you right here, what are you seeing in silver moving forward?
In silver, we've evidenced exactly the same house position concentrated strategy to cap silver by fractionalizing the March silver contract, where bets were made against the March futures contract at $29. Now, at the contract's inception point on the 29th of July, with spot silver at $27.50, the contango, to lock it in, there was a massive $1.37. That is $6,850 per contract premium. And you can see that in the corner of this illustration. And that was just to cap the futures price at $29. Now, think about it. When accounting for the locked-in $1,370 containment profit, so as long as silver didn't rise above 29 at contract expiry, that is, because they are stick-handling undeliverable, unallocated foreign exchange silver positions being called for by Asian buyers into supply deficits, these house insiders were forced to go long to hedge this exposure at $29, hence the COT support there, the commercial support there.
Now, you've just looked at the screenshot where we captured $1.37, that's $6,850 per contract premium, which was being gamed and arbitraged to really just to cap the futures price at $29, and which again would have been the exact support level. The March contract, this is the current live price, so it's currently 64 cents, which is ludicrous when you consider that in fact it was 40 cents. Really just a couple of days ago, 41 cents. It should be in the 40-cent range, and legitimately probably in the high 38-cent range or thereabouts. So in other words, it's still being gamed. Now, it's a thin liquidity day today, so that's expanded to 64 cents. But this is really just bringing up to date what you just looked at and how they've contracted this $1.37, even today at extended levels, to around 60 cents. Now, so what's going to happen is This March contract has got until February the 27th to reach parity with FX spot. And as of today, they still currently have this arbitrable current 60-cent spread cushion, but it will rapidly shrink to zero by February contract expiry. Now, similar to gold futures, these same actors have gone long into deeply oversold conditions. Now, we're looking at the daily chart, going all the way back to 2020. Now, what the liquidity providers are saying is they expect the commercials to be first, obviously, to ring the register on momentums the moment they're selling stalls, because they're wrong at both ends. But they're going to equally benefit from being long against these naked short sellers when they ring the register. Now, liquidity providers also assess the inflection point for the gold and silver is very close to sparking a March 2020 COVID-like short squeeze this first quarter, especially as these same liquidity providers continue to report very large Indian buying is competing with Chinese demand above spot $30. Now, there is so little on offer at current prices, the offer to sell physical silver will have to rise to meet this demand. And when silver breaks out, everyone who has been lulled into believing this synthetic range will continue will pile in together. And while gold, we're looking at a 240 chart, a 4-hour chart here. And again, if you compare that with silver, it's sideways. It's this huge capping level. But again, why did they cover at 29? Is because they don't want it below 29. So again, this is then because there is a physical market that's starting to absorb this stuff. So these same actors in silver futures are running out of sufficient momentum sellers to effectively cap the real supply-demand price of silver. It will break out. And just a quick look at the monthly charts, and really no damage done. And while we saw this end of December gaming, guess who the buyers were? The same commercials exposed to physical deliveries. And that is the 50% retracement FIBO. That's really triggered, and the fact that this held will have spooked the momentums who really ought to start thinking about covering pretty soon. Look at the same thing in much harder to hide gold, and most certainly we're looking at a $3,000 price. And this really demonstrates what gold did in 2024, closing right here.
So, pulling at this synthetic gold and silver action, putting it all together. So, driven by central bank, sovereign, and institutional safe haven physical demand, gold and silver made significant gains in 2024, with gold and silver prices increasingly being discovered in fully physically backed BRICS-facing exchanges. And this physical demand will continue to accelerate in 2025. Now, while gold benefited from its monetary role as an investment metal, as has silver attracted similar safe haven demand, though, silver's also gained from the increasing demand for its climate-friendly applications. And we're looking at EV battery advancements, photovoltaics, and etc. There's a ton of it, but it also has been attracting safe haven demand, which is why sometimes we're seeing silver counterintuitively rising alongside the dollar. Now, it is tightness in physical supply at current prices, that will force gold and silver to break out. And under the smoke and mirrors COMEX-driven action is what we're looking at through the physical markets. It is through that lens that is providing us a far more bullish outlook than is being spun by Western-facing analysts. Now, what's not being factored in to current gold and silver price forecasts is both gold and silver are increasingly breaking free of their inverse dollar and bond correlations. So rising bond yields resulting from impossible to justify rising debt levels into a wrong-footed Fed, And I'm surprised there hasn't been a buyer strike yet. And the unknown effect of Trump's upcoming tariffs, again, uncertainty, they're accelerating these dislocations as safe haven demand is these US treasuries and dollars are being converted into gold. Yet the old guard Western-facing analysts, relying on historical correlations to keep on going regardless, blinkered to what's going on, see rising bond yields and a rising dollar as limiting gold's upside because none of them have a view into where real physical prices are being discovered. And if they do, they're deliberately trying to spin it down. For example, while still bullish on gold, at the open of January trading, Goldman Sachs pushed out its 3,000 gold price projections for 2025 out to 2026, based solely on synthetic market expectations that a rising dollar and bond yields will cap gold from rising to $3,000 in the short term. However, all our first-tier liquidity providers, and yes, one is a market maker at Goldman Sachs, assess that they are forced to unwind the forced unwind of dwindling COMEX open interest flowing into markets getting physically settled outside the COMEX LBMA machine which is a bubble, will continue to evidence the dumping of US treasuries for gold and conversions of the strongest dollar since November 2022. This exacerbates the break in historical inverse correlations. Now, liquidity providers see safe haven gold and silver rising alongside the dollar and bond yields. Obviously, on an intraday basis, you might see that volatility. It might start to because the momentums will jump on it. But guess who's buying that? The same commercials are exposed and the bullion markets are exposed to outflows of bullion. So the truth be told, Goldman Sachs are very long both physical gold and silver for their own book, and par for the course clearly don't like the competition and will be proved to have been driving the gold price up to $3,000 by the end of the first quarter. Almost certain. We've seen their counterintuitive calls. They usually trade against what they call the Muppets. They've used that term before on their speculators, on their clients.
Andrew, a question that seems to be popping up a lot here is how might recent geopolitical tensions all over the world influence precious metals markets in the coming months?
Well, the short answer, Shane, is whether it's war or peace. Either way, US Treasury gold is going to have to be revalued higher. Now, this is not a wild assessment. This is backed up by someone close to the new administration. And to stem the de-dollarization flows into mispriced bonds and an overpriced dollar relative to gold, the US cannot remain the sole outlier to the Bank of International Settlement compliant European, Asian, and BRICS-facing central banks. In other words, every other central bank. And it's assessed there at the very least, the Treasury will have to back the US dollar with a more realistic current gold price, not the tiny price that it's valued at now. Now, I will elaborate on this by the next episode, but I see this as a bullish event, as bullish an event as when gold was revalued as a first-year asset class 2 years ago in January 2023. I see this as being a several $100 rise in the global price. Now, I haven't posted on X for the longest time. I just haven't had the time, to be honest. But I will do if actually more comes to light before the next episode. So the question, of course, that comes into your mind is how will this impact gold? Well, for this to play out equitably, our liquidity providers suggest the dollar price of gold would have to be pegged, even if they fractionally back their dollar a little bit closer to, say 4% of GDP or whatever. But it has to be $3,000. But that in itself would force a huge rally, global rally. This would make it also impossible to block silver from breaking out of its current cap range, likely requiring a minimum price of $50 per ounce. It is a safe haven metal. Now, there are a couple of other bullish drivers, which perhaps we can cover in the last few couple of minutes of the episode. So really, let's look at the bigger picture. In addition to the power of Siberia pipeline, potentially providing China with heavily discounted energy, and in the order to halt, there's an attempt to halt progress of the proposed Russia-Kazakhstan gas pipeline. Also, all of this is going to provide China with limitless flows of tariff offsetting cheap energy. That cannot be allowed to happen from a Trump regime. And it may well behoove Trump's regime to quickly settle Ukraine and to begin to unwind sanctions against Russia, all of whom are loaded with gold. And this would serve two purposes. Basically, to drive a wedge between the two BRICS anchors. I don't think it will, but it would be an attempt to do so. And to secure cheap Western energy deals. And by enabling Russia to access the SWIFT network again, it would drive I don't know if they would trust it, it would drive the BRICS-related Russian-European energy trades to be settled in dollars, which would certainly benefit the US. And as Andrew I can never pronounce his name, Korobiko, suggests in a recent assessment, it is plausible the US and Russia could agree to a series of mutual compromises, culminating in the partial restoration of an energy bridge between Russia and the West for the purpose of depriving China of its envisaged decades-long access to ultra-cheap Russian resources for fueling its superpower rise. Bear in mind, we're talking about a military enemy here. So here we are at the start of 2025. And at a minimum, we expect 3,000 gold and silver to break out as soon as the first quarter. So the question is exactly the same as posed in January 2024 in our first episode, when gold was priced at $2,000 and silver was at $22.80. How much physical gold and silver do you own?
All right. Thank you, Andrew Maguire, for talking gold. And remember, to our growing Live from the Vault community, buy physical and make sure it's backed 1-to-1 and understand the difference between what Andy calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. All right. So there you have it. That's all we have for you today on our first episode of Live from the Vault. And please help keep spreading the word as we move into 2025 about this channel by hitting that like button. If you haven't already done so, come on, hit the like button, share this information, and subscribe if you haven't already subscribed. And if you hit the black bell right there, just hit the bell. You'll be notified as each episode goes live, so you won't miss a thing here in the precious metals industry, this insider information. With that, we'll see you right here next time on Live from the Vault. See you then.